Today, we're diving into something that affects all of us, the natural rhythm of the economy. It's called the business cycle. We're going to break down how to read its signs and figure out what they might mean for the markets. Does the economy ever feel like a total roller coaster to you? Seriously, 1 minute, things are booming, everything's flying high, and the next, it feels like we're in a nosedive. Well, guess what? That's not just in your head. It's a real, fundamental pattern. But what if I told you there's a map for this crazy ride? Well, that map is the business cycle. It's basically the repeating pattern of ups and downs, growth and decline, that our economy is always going through. Now, it's not always super predictable, but getting a handle on this cycle, that's absolutely the first step to making sense of the bigger financial picture. Okay, so a really easy way to think about the business cycle is to picture the four seasons, right? Each phase has its own vibe, its own unique feel, and one just naturally flows into the next. So let's take a walk through this economic year together. All right, first up, you've got the expansion. Think of this as our economic springtime. Things are growing, companies are hiring, profits are looking good. Eventually, all that growth hits its highest point. We call that the peak. That's the middle of summer, right? After that peak, things start to cool off. That's the contraction, our economic autumn, where activity slows down. And finally, the cycle hits its lowest point, the trough. That's the dead of winter, economically speaking, right before a new spring, a new expansion starts all over again. So, the big question is, how do we actually know which season we're in? It's not like you can just look out the window and tell. Nope. For that, we use something called economic indicators. You can think of these as the road signs, the GPS, and all the gauges on your dashboard that help us figure out where we are on this economic highway. Okay, first up, we've got what are called leading indicators. Just like the name says, these are the forward-looking signs. They're trying to tell us what's coming up around the next bend. They're all about predicting where the economy is going, giving us a sneak peek into the future before it actually happens. Then you've got the coincident indicators. Now think of these as the speedometer right on your dashboard. They aren't trying to predict the future. Their job is to give you a real-time snapshot, telling you exactly how fast the economy is going right here, right now. And last but not least, we have the lagging indicators. These are, you guessed it, like looking in your rearview mirror. They're not going to tell you where you're going, but they are great at confirming a trend after it's already started. They give us that crystal clear picture of the road we've just been on. All right, let's put some real-world examples to this so it makes sense. For leading indicators, the ones that predict the future, we're talking about things like the stock market or how confident consumers are feeling. For coincident indicators, the right now stuff, the big one is GDP, or gross domestic product. That's just the total value of everything a country makes. And for lagging indicators, the rearview mirror, a classic example is the unemployment rate. Think about it, that number usually only gets better well after the economy has already started to recover. So, did you catch that? I mentioned the stock market as a leading indicator. This is a really, really important idea to grasp. So why is that? Why does it seem like the stock market has its own crystal ball? Well, here's the thing. The stock market isn't just reacting to today's news. It's not looking at yesterday's economic report card. It is constantly trying to look ahead, to guess what's coming down the pike. It simply doesn't wait for good or bad news to be officially announced. Because in a lot of ways, the market is the news before it happens. See, it acts like this giant collective bet on where the economy is going to be, say, 6 to 9 months from now. It's pulling together the forecasts and feelings of millions of people about future profits, future conditions, the whole shebang. And that's exactly why the market often hits its peak before the economy does, and why it can bottom out while the news is still talking about how bad the recession is. Okay. So what does all this theory mean for you, for investors? How do we connect this big picture economic cycle right back to your wallet? Well, just like you'd wear different clothes in different seasons, different investments tend to do better in different economic seasons. So during an expansion, that economic springtime we talked about, the idea of rising company profits makes stocks or equities look pretty darn attractive. But when the economy starts to slow down, you'll often see investors shift their focus to the relative safety of things like bonds. See, understanding the cycle can help you anticipate these kinds of shifts. For instance, during a recession, certain defensive parts of the market, like utilities and healthcare, things people need no matter what, they tend to hold up better. And at the same time, you might see central banks step in and lower interest rates to try and get the economy moving again. And that action can actually make things like bonds even more valuable. But hold on. Before you run off and change your entire investment strategy, there is one huge thing to remember. These indicators, they're just signals. They're not guarantees. They are incredibly powerful tools for sure, and they help you make more informed decisions, but they are not a perfect crystal ball. Really, they're just giving us important clues to a very, very complex puzzle. So, I'm going to leave you with a question to chew on. You now have the map, the business cycle, and you know how to read the road signs, those leading, coincident, and lagging indicators. So take a good look at the economy around you, all the news, what you're seeing in your own life. Based on all that, where do you think we are on the map right now?